Let's invite our next guest, Sunil Koul, the APAC equity strategist at Goldman Sachs, joins us now with their view. Sunil, pleasure speaking with you on CNBC TV18. You know, the view now, the narrative now is that we're getting into sort of a restrictive monetary policy cycle globally, not just with the US, and that could put risky assets on the back burner. But we haven't seen that play out in India. Do you think this decoupling, so to speak, of the Indian markets is something that can continue? And how are you feeling about the Fed decision overnight?
Yeah, I guess just on the Fed decision first, Sonia. Look, I think the 75 basis points hike which we saw was in line with our expectation. The guidance obviously was a little bit much more hawkish, both in terms of the dot plots, but also in terms of the press conference later. And so we were actually looking at the Fed terminal rate of 4 to 4.25 range, and obviously the target rate was 50 basis points higher. So as a consequence of that, we also just changed our rate forecast. So we are now looking at a similar target Fed fund rate at 4.5475. So clearly, I think for markets, what it means that you will have rates going higher, more tightening coming through, and the combination of slowing global growth, higher rates, as well as dollar, which still seems to be on an uptrend, means that risky assets, to your point, will continue to have a tough time. Now, the way you want to be positioned generally is quite defensive. And so India kind of checks that box where it's one of the domestically demand-oriented markets, somewhat more defensive. But I would still point the fact that valuations in the market are a little bit more extreme, or on the higher side, at least in terms of premium to the region. And so our base case here is that markets consolidate, at least on the next 3 to 6 months. I'm not sort of looking for any major price correction, but more a sort of time correction before you see fundamentals catching up.
Okay, that's a fair point. Sunil, hi, good morning. So, you know, the issue is this terminal rate target is also, getting increased and it's now a bit open-ended, right? So, in that sense, and since you mentioned valuations, what's your view on the Indian IT, where we have started to see quite a bit of reset, and there are concerns now on what's happening with the margins and maybe this quarter even top line? Do you think there needs to be more reset here?
Yeah, Anuj, that's a great question. I mean, just on the terminal rate and rate side of things first, I would say, look, I think the overall trajectory clearly is up on rates. The market is kind of still pricing in some cuts later in 2023, which still feels a little bit optimistic to us. And so I think there is more risk or downside risk in terms of the risks from higher rates as opposed to any upside risk here. The other thing on the rates, which is relevant here, is I think if you look at the potential increase in rates we'll see, it's more likely to come in from real rates as opposed to inflation side of the things. So which means the real rates generally tend to weigh on valuations, which is important in the overall context of things. And obviously, as we discussed at the front of the call, we are seeing tightening not just in US but elsewhere as well. And India, I think, is in that camp too. Specifically to your question about IT, we actually did downgrade the sector recently, and so thought was basically, look, the market is still optimistic in terms of the US dollar revenue growth in there, looking at double-digit growth. So we think the top lines will slow down to sort of a mid-single-digit 5-6% growth, whereas valuations still are on elevated side around sort of 23-24 times for the sector as a whole. So to us, looks like the valuations are still not factoring in the potential down cycle you can see in the tech sector. Obviously, I know that the sector has underperformed, but we still think there is more to go in here.
It's interesting you have, it's interesting you have downgraded all the top IT stocks, Infy, TCS and Tech Mahindra, but you've upgraded Wipro to a buy. I just wanted to understand the rationale there. The entire sector is going through both a margin and a top line slowdown. Is it fair to upgrade, Wipro, which hasn't really outperformed its peers in a while?
Yeah, I mean, Sonia, without sort of getting into single stocks here, I would say I think the relative pecking order within a sector is more the analyst call in terms of where we see there's a better risk reward in some stocks relative to other stocks. But the fact, as you mentioned, we are downgrading the top 3 stocks in the sector, and we are underweight the sector as a whole, generally means that we think the overall sector should continue to underperform the broader markets. I think that's the core view out here.
Sunil, hi, good morning. Prashant here. So you look at the Asia-Pacific strategy, right? I mean, you write extensively about it. So this is a slightly zoomed out kind of question. One of the things which people use sort of talk about to explain the vast outperformance of India is the fact that since India gets most of its flows, foreign flows, via emerging market funds, not really dedicated country funds. And the rest of the emerging market, a lot of the other emerging market countries in an index like the MSCI emerging market are suffering for one reason or the other. India stands out. And it does stand out. So it should get and is getting and will continue to get disproportionate amount of money. There is also talk about, EM funds, ex-China, etc. And I don't know how much money they will get. Are you seeing those kinds of things, and how much is that kind of really responsible for the outperformance we have on our hands?
Yeah, Prashant, all great questions actually, and we are having similar conversations with a lot of clients. I would say, I mean, there is a lot to unpack there. On India's outperformance first, I would still sort of make a point that Indian equity markets, even though it's a large domestic economy, it's still sort of correlated to global equity markets, right? So the rally we saw in the summer between sort of June to sort of August, you actually saw global risk on at that time. The global equity markets in aggregate, if you look at MSCI All Country Pacific, All Country World Index, was up 13% during that time. And India was like 17-18% in local terms, if you adjust for the currency a little bit lower. So there was clearly a global rally going on. And so that actually helped India. Similar to that, I mean, we obviously saw the correction before that from 18,000 to 15,000 on Nifty. So we had a 15% pullback as well. So it just shows that Indian markets are moving along with the global markets. But I think the second point you mentioned, which is equally important, is that around the same time, we did see a lot of negative news flow around in China, especially around the property sector. And so we did see people moving money into defensive and domestic markets like India. I mean, as a side point, if you look at the regional markets year to date, the market which has actually done the best is Indonesia, and India is actually at number 2, and so that actually shows you that the investor community has kind of gravitated towards South Asia, and within South Asia, the markets where you see there is more kind of domestically demand driven growth, and so I think that relative outperformance may continue here, but I also point out that if you sort of look at the starting point of valuations, that is on a higher side, which means on a more 12-month basis, you may not see as much upside in the indices that you have seen before. On your flow question, also, I would say it's true that India did see quite a bit of inflows in the month of August, like 6-7 billion. If you look at the trends in September, we have already seen a little bit of slowdown in the flows, right? And it's, I think, tied to the global environment overall. If you look at the EM funds, what's interesting is that we have actually been seeing outflows from the EM active funds for a while. In fact, year to date, the EM active funds have actually seen close to $20-25 billion of net outflows. What has been holding up the flows is ETFs, EM ETFs, and the fact that India, because of its outperformance, its weight is also increasing, and then it's acting as a hedge to China, means that flows into India via the passive route have been increasing. But interestingly, if you sort of look at the past 3-4 weeks, we're also seeing a slowdown in the ETF flows. So I think my limited point here would be, I would be less optimistic about the flows, at least in the near term, from the global side, because of the slowdown we are seeing overall. And also keep in mind that dollar is still on a strengthening path, and there is a very strong correlation between EM flows and dollar.
Got that point. Sunil, actually, that's my next question then, because, for this money, which has, and, there's no way of knowing exactly how much money is long-only funds, how much is ETF, right? But there's an assumption that a lot of money has come via the ETF route, and that normally chases momentum. So if the momentum flags down, and, I take your point that, with a lag, maybe the market will correlate with the global market. And in that case, are we at risk of some kind of big outflows as well, if the momentum sort of, does not keep pace with the kind of returns that we have seen over the last 3 months or so?
Look, I think global risks are there. I will still emphasize that from a pure fundamentals point, we still think India is a very strong secular growth story. And in fact, we did some work very recently in terms of looking at trended earnings growth potential in the markets over the next 3 to 5 years. And within the region, India actually stands out as the most, as a market with the highest trend earnings growth of around 14-15%. So I think on the fundamental side, and we can talk more about that, there is clear signs that there is the domestic recovery has been very strong, right? So from a pure fundamental standpoint, I wouldn't think that there should be huge outflows from India. I was sort of pointing out to the fact that if the overall global environment generally is where flows are generally slower, India may therefore also be a part of that overall. So I think that's something to keep in mind.
Okay, and sorry, one follow-up. Are you tracking the domestic liquidity in India? Because that's something which has kept markets in good stead. And, earlier if we had this kind of FIS selling, the market would not have got away with 18% cut, which the market did this time. Any views here?
Yeah, for sure. I mean, we actually do track the domestic flows pretty closely. And that actually speaks to one of the risks we have. But I think, as you correctly pointed out, Anuj, the domestic flows is the reason the market is still trading where it is. If you had the similar amount of foreign selling we saw earlier in the year, which we know was almost 2 times what we have seen during the global financial crisis, market should have been much lower. What's interesting, and I'll make 2 points here. I think what's interesting is that if you look at the monthly data that comes out from AMFI, notably the both, not just the SIP data, but the overall monthly numbers as well, we are now seeing slowdown in the monthly numbers for 4 months in a row. If you look at the latest monthly flow in the month of August, we had close to $1.7 billion inflow. That's kind of adding the index funds in there, which is how we look at it, which was almost equal to what the SIP number was. I think what it means is that you literally had zero buying from the discretionary side or HNI side of things. And maybe it's basically that at sort of the 18,000 psychological level, people are basically booking profits. Because if you sort of look at the details between gross purchases versus redemptions, you had a 60% increase in month-on-month redemptions. So I think it's really clear that you are seeing some slowdown in domestic flows, and at a time where if the global flows slow down and your domestic flows also are not there to support it, that could be a risk for the markets. Having said that, I would say I don't think this is an imminent risk, because if you look at the mutual fund, domestic mutual fund cash balances, as per our estimates, they are still running high at about $6 billion. And if you look at the cash balances as a percentage of the AUMs, we are still at 2 to 3 year highs. So I think there is still sort of firepower to support the markets. But one risk to keep in mind is potential reasset allocation from sort of equities to fixed income as the domestic fixed income deposit rates keep going higher.
Okay, that's on the overall market picture, right? I wanted to drill it down to specific sectors, because one sector that you feel is at an inflection point is microfinance. So there are names like Bandhan Bank, IndusInd Bank, L&T Finance, that you folks think are better ways to position the MFI recovery. But, if you look at, I mean, not getting into individual stocks per se, but if you look at the charts of some of these names, like, say, L&T Finance, these stocks have done nothing in the last 2 years. Do you think that the fortunes are going to change?
Look, I'll say in terms of the overall banking sector as a sector, obviously, we all kind of know the well-flagged 15% credit growth number, which is at 9-year high. But I think it's a fact that if you look at the overall banking sector at this point in time, you have the capitalization positions in the balance sheets, which are at the best positions they have been since the global financial crisis. We have kind of signs of credit demand picking up, not just because of the urban consumption, but also the fact that you're seeing sort of some revival in the capex cycle, right? And we would probably have a couple of more quarters of margin expansion as well because of the delayed repricing on the liability side. So you put all of that together. In general, we think banks should continue to do better here. I know that probably sounds like a consensus idea at this point in time, but we do think in this sort of stronger upcycle, you probably get to like a 20% compound growth over the next sort of three to 5 years, which should mean peak ROAs and ROEs for the banking sector as a whole, including the microfinance story in there.
Sunil, 60-second answer to China. beyond the point no one knows anything, but you guys track it closely and you've written about it as well. What's happening? You think there are elections? Do you think they can change course dramatically? Because China +1 and all the ills that China is plagued with right now has been a big cause for, this supply chain diversification and portfolio flows, everything, right? Can they course correct significantly, or you think there's a slowdown which has to happen there, which will continue for a while?
Look, I think the short answer to your question, Prashant, is slowdown for sure we think will happen. If we just look at our numbers, both in terms of profitability as well as GDP numbers, we are meaningfully below consensus there. So given the stresses we are seeing in the property sector, we do think China growth will slow. I think there is a lot of expectations on potential reopening in China after the 10th Party Congress, 20th Party Congress in mid-October. We think that will be delayed until second quarter of year because of both healthcare as well as personal reasons. But at some point in time later in the year, we do think China sort of opens up and some recovery can come through. But overall, to your question, I think this bigger theme of China overall slowdown and sort of China +1, which benefits India, should still be in place.
All right.
Although in terms of equity markets, China may do slightly better heading into next year because of cheaper valuation and some policy easing. But from an India standpoint, I think the slowdown in China and India benefiting in terms of supply chain theme still pretty much is in place.
Okay, Sunil, I tell you what, it was a pleasure to talk to you. It's so much clarity on all the issues that you gave us. Thanks a lot for joining us. Appreciate your time and look forward to more conversations with you in future.
Thank you so much.
Okay, that's the view from Goldman Sachs. By the way, the market is seeing a lot of volatility intraday. The one thing which stands out is mid-cap index is outperforming and it's comfortably in the green, 2:1 on advanced decline. We'll take a break. Up next, we have a couple of corporate voices. Ramani Dhati of Teamlease Services will be joining us to discuss the hiring trend. And later, we'll be joined by N. Kamakodi of City Union Bank. That's been one of the big outperforming banks. So stay tuned for both these conversations.